Why is euro to US dollar dropping today? The answer is in the bond spreads and the persistent hawkish repricing of the Federation euro to US dollar forecast for the week hinges on whether 1.1424 holds as support or flips to resistance. Euro to US dollar just hit a critical decision point at 1.1424, and there is one danger zone and one hidden opportunity right now. I'll show you both. Most traders are piling into shorts after Lagarde's dovish comments, but the data suggests they might be late to the party. Stay to the end. I'm giving you 3 exact levels you can trade today. Let's get into it. Here's the instant market verdict. Euro to US dollar is in a trending sell-off across every single time frame. Monthly, weekly, daily, 4H, 1H, all showing strong sell momentum. That's rare. But here's the catch. When everything aligns in one direction, the risk of a violent mean reversion increases exponentially. Write this number down. 1.1424. If we break below today on a daily close, the entire structure resets and we are looking at a fast move to 1.1376 and then 1.1297. But if we hold above 1.1424, prepare for a squeeze back toward the pivot at 1.1504, the herd is positioned for a breakdown. Retail sentiment is showing extreme short positioning. Over 70% of retail traders are selling the euro. That's exactly when the market tends to do the opposite. The institutional positioning is more nuanced. Hedge funds are scaling into shorts but with tight stops. The real money is sitting on the sidelines, waiting to buy dips. Let me walk you through the technical deep dive. And I want you to really see what's happening at the structural level. Starting from the weekly chart, euro to US dollar is trading well below its MA20 at 1.1606, MA60 at 1.1635, and MA200 at 1.1583. The 200-week moving average is sitting right here, acting like a brick wall that price broke through last week. When you lose a key MA like that, momentum accelerates to the downside. That's exactly what we are seeing. The daily chart confirms this bearish structure. Price is below all major moving averages. MA20 at 1.1549, MA50 at 1.1606, MA100 at 1.1635, MA200 at 1.1583. The slope of these moving averages is flattening then turning lower, which reinforces the bearish bias. But here's where it gets interesting. Look at the MACD on the daily. The signal line is diverging higher while price makes lower lows. That's a classic bullish divergence. Most traders miss this because they're too focused on the price action alone. The selling momentum is waning even though price is still falling. That's a warning sign for shorts. Now drop down to the 4H chart. The MACD here is showing the same negative momentum, but the histogram is shrinking. We are seeing a negative divergence on the 4H timeframe. Buyers are exhausted, yes, but sellers are also losing conviction. The RSI on 4H is at 32.8, approaching oversold but not quite there yet. On the 1H chart, things get even more extreme. RSI at 31.4, Williams percent R at negative 95.6, CCI at negative 146, all indicating oversold conditions on the shorter time frame. The ADX at 36.06 confirms a strong trend, but the CCI suggests we might be due for a pullback. Here's what most traders miss. The confluence of support at 1.1424 is not just a random number. It's the S1 pivot level. It aligns with the low from 2 weeks ago, and it's the 78.6% Fibonacci retracement of the move from 1.1297 to 1.1709. That's a triple confluence. When you have that many technical factors lining up at one price level, you need to pay attention. Here's the hidden divergence that changes everything. While euro to US dollar is making lower lows, the German 10-year yield is showing relative strength, and the US 10-year yield is struggling to hold above 4.5%. The yield differential, which has been the primary driver of this move, is starting to narrow again. This tells me the fundamental driver might be reversing before the price shows it. The market is pricing in a hawkish Fed, but Fed fund futures are already pricing in a 60% chance of a rate hike. That's almost fully priced. Meanwhile, the ECB is sounding dovish, but inflation expectations in Europe remain sticky. The cross-asset linkage here is critical. Gold is up 0.8% this morning, signaling a weakening real yield environment. When real yields fall, the dollar typically weakens. So while euro to US dollar is down today, the macro backdrop might be shifting beneath the surface. Let's connect this to the fundamental driver from the last 24 hours. Yesterday, ECB's Lagarde played down second-round inflation fears. That's a dovish tilt, but here's the nuance. She also acknowledged that services inflation remains elevated. The market interpreted her comments as a green light for easing, but the reality is more complex. The ECB is trapped. They can't be too dovish because services inflation is still running hot, but they can't be too hawkish because the growth outlook is deteriorating. This policy divergence battle with the Fed is reaching a tipping point. The market is pricing in the Fed being more hawkish for longer, but I think that narrative is getting tired. The core news to watch this week is US GDP and PCE data. If those numbers come in softer than expected, the dollar will roll over quickly. If they beat, we test 1.1376 and potentially 1.1297 for the 1 to 2 week directional lean. I think we are overdue for a corrective bounce. The sell-off has been too one-sided, too fast, and the momentum indicators are flashing extreme oversold signals. But the trend is your friend, and the trend is down. So I'm looking for a tradable bounce to sell into, not a trend reversal. The event that invalidates this view is a daily close below 1.1376. That would signal that the selling pressure is accelerating and the support has given way. At that point, the path of least resistance is firmly lower toward 1.1297. Do you think the dollar breaks 105 this week? Comment yes or no in the comments right now. I'm tracking consensus. Drop your euro to US dollar range for tomorrow in the comments as well. Now let's get into the trade. Setups. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1, the sniper, conservative. This is for traders who want a high probability, low risk setup. I want to see price hold above 1.1424 on a 4H close. That's my trigger condition. The confirmation signal is a bullish divergence on the 4H MACD or an RSI cross above 35 at entry. 1.1450 on a 4H candle close above 1.1440. This gets you long after the initial squeeze starts, not before. Stop loss below the 4H demand zone at 1.1376. That's 74 pips of risk. The logic is that if we break below 1.1376, the support structure is compromised and the setup is void. Target 1, 1.1504, the daily pivot. That's a 54 pip move for a risk-reward ratio of approximately 0.73 to 1. Not great on its own. Target 2, 1.1582, the R1 resistance. That's a 132 pip move for a risk-reward ratio of 1.78 to 1. That's where I'd take partial profits and trail the rest. This setup is void if we get a daily close below 1.1376. That changes the entire structure. The sniper, conservative, entry, 1.1450, for H candle close above 1.1440, stop loss, 1.1376 take profit 1, 1.1504 take profit 2, 1.1582 risk, reward, 1:1.78 R invalidation, void if daily close below 1.1376. Strategy 2, the active trader, standard. This is the setup I'm personally watching most closely. It combines mean reversion with trend continuation, giving you a solid risk-reward profile. Entry condition, a pullback to the 1.1424 to 1.1440 zone with a bullish rejection candle on the 1H timeframe. I want to see a hammer or a bullish engulfing pattern at this support confluence. The reasoning is that 1.1424 is the S1 pivot and also the level where we saw buying interest earlier in the session. Stop placement below the range low at 1.1376. This gives you room to breathe without being stopped out by a liquidity sweep. The logic is that if we break below the S2 pivot at 1.1376, the bearish momentum is accelerating and you don't want to be long. Target 1, 1.1504, the daily pivot. That's a 68 pip move from entry at 1.1436, for a risk-reward ratio of 1.07 to 1. I'm taking 50% of the position off here, target 2. 1.1582, the R1 resistance. That's a 146 pip move for a risk-reward ratio of 2.3 to 1. Once target 1 is hit, I'm moving my stop to break even and letting the rest ride, trailing stop rule. Once price breaks above 1.1504, move stop to 1.1480. If we break above 1.1550, move stop to 1.1520. This locks in profits while giving the trade room to run. Active trader, standard, entry, 1.1436, pullback to 1.1424 to 1.1440 plus bullish rejection, stop loss, 1.1376 take profit 1. 1.1504, 50% position off, take profit 2. 1.1582, trail remaining, risk, reward. 1:2.3 invalidation. Void if 4H candle closes below 1.1376 trailing. Stop to break even at TP1. Trail higher above 1.1504. Type your euro to US dollar range for tomorrow in the comments now. Let's see who's aligned with the levels I've just shown you. Strategy 3. The aggressor, high risk. This is the counter-trend chase. On smaller time frame. Extremes. Only for those who can lose small and manage risk aggressively. Entry, 1.1410 or better. I want to see a spike below the 1.1424 support, triggering stop losses from retail traders, followed by a quick recovery back above 1.1424. This is a liquidity grab play. The market shakes out weak hands then reverses, stop loss, 1.1376. Same as the other strategies. The invalidation is clear. If we break below 1.1376, the trend is accelerating lower and you need to cut. Target 1, 1.1504. That's a 94 pip move from 1.1410, for a risk-reward ratio of 2.7 to 1. I'm taking full profits at target 1 or moving to break even aggressively. Target 2, 1.1582. That's a 172 pip move for a risk-reward ratio of 4.9 to 1. But I would only hold for this if the momentum is explosive. Explicit warning. This is a high-risk, low-probability setup. You're trading against the trend. Only take this if you have a small position size and you're prepared to lose your stop quickly. This is not for beginners. If you're unsure, stick with strategy 2 or 1. The aggressor, high risk, entry, 1.1410, liquidity sweep below 1.1424 plus recovery, stop loss, 1.1376 take profit 1, 1.1504, full position or trail aggressively, take profit 2, 1.1582, conditional on momentum, risk, reward, up to 1:4.9 warning, counter trend, tight stops, small position size, invalidation, 4H close below 1.1376 now, risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news. With GDP and PCE coming later this week, you need to be nimble. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for the next session. That is 1.1424. Everything hinges on this level. Holding above signals that the selling pressure is exhausted and a bounce is imminent. Breaking below opens the door to 1.1376 and 1.1297. Tomorrow's focus is on the US advanced GDP and weekly jobless claims. If GDP comes in below expectations, expect a sharp dollar sell-off and a rapid bounce in euro to US dollar toward 1.1504. If GDP beats, we test 1.1376 quickly. But here's the wildcard, the bond market. If the 10-year Treasury yield starts to roll over below 4.4%, that's a green light for euro longs regardless of the GDP number. I'll be watching that like a hawk too. If you want the full breakdown on how this euro to US dollar setup connects to the broader dollar index and what it means for your portfolio, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. Remember, 1.1424 decides everything, and for those of you sticking around, tomorrow's video breaks down gold's reaction to the falling real yields and why it could be setting up for a major breakout. The divergence between the yellow metal and the dollar is widening, and I'm seeing a setup that could yield 3-to-1 risk reward. Don't miss it. See you on the other side of the trade.